is the next, there we go, this is today. Okay. So we're going to talk about a key rule component to all this that just is so often overlooked. And it's really, everyone talks about, we talk about supply, demand, and supply zones, demand zones, but very few people talk about the middle. So we're really going to focus on that today because it's such a key component to everything we do. And yep, we can certainly look at that Euro Swiss. I was just looking in the chat. We're going to spend all of our time in the live markets today because I want to demonstrate what I'm talking about here. So let me go and do that. Go. Let's just put that away. Get back to this. Hey, Ramon. All right. Yeah, actually, I see your message in the chat there about London. And yeah, those may be coming back very soon. So a little bit different format, but better. So look for that. Stuff is in the works. All right. So we can really use any market we want to talk about this, to demonstrate this. Okay. So let's go to let's go here for a moment. So you can see we're looking at a live chart of the S&P. And if anyone has a favorite market or a market they want to look at, just put it in the chat. We can use that, look at that. When we apply what we focus on here is the original, the real supply demand strategy. And when we do that, it doesn't matter what market we're looking at. Really doesn't matter. Okay. Sure. All right. I don't see anyone asking for the S&P, so we can go. Alan, why don't we go to the NASDAQ then? That's your first choice there. And then Shubham, we can look at gold. Actually, why don't we start with gold? Because gold is in a spot that is perfect for what I'm talking about right now. Okay. Let's go to gold. And you'll see if we go to, I believe it's this chart right here. So there's gold. Those are the supply demands. So when you see lines on the, when you see these supply demand zones on the chart, so these are the zones that we go over with our members every morning. And if any of you want to be in those sessions, I don't know if any of you are in those sessions, but any of you can join those sessions. We have we launched a little while back a new membership that just about anybody can join if they want to. It's like $49 a month, and it's just we're able to do that finally. So feel free to jump in those sessions if you like. But this is a chart of gold, and the important thing here is we've got our supply zones up here. This one already hit. We have our fresh demand zone down here, but it's the middle that we want to focus on during our session today. Okay? And if you think about how any market works, it's not just supply and demand, right? It's supply, demand, and fair value. As you can see in this chart, like any market on the planet, price spends most of its time in the middle or at fair value, whatever you want to call it. And I know we're talking about the trading markets here, and we always talk about the trading markets here. But if you think about it, how any market works, when you go to the store, the market for food, all of the items that you look at there, all of the products we buy in any other store has supply or retail prices, demand or wholesale prices, and fair value, which is the middle, right? Now, the store would always love to sell at extreme retail prices, but you wouldn't have enough people willing to buy there, so that wouldn't work. As a consumer, we'd love to always pay wholesale prices, but again, the store wouldn't make any money, so we wouldn't have the market, and so that wouldn't work either. So what happens is how price is naturally regulated, and I know this is going back to like middle school economics 101, but how price is regulated in any market is simply the majority of buyers and sellers in a market agree to buy and sell somewhere in the middle, right? And that's fine. Now, we don't want to do, here's the thing that gets people. That's what most of us do in any other part of life. When we buy food at the market, when we buy a car, a house, appliances, anything, clothes, food, plants, whatever. We all buy somewhere in fair value, right? Sometimes we get it at wholesale prices. Sometimes we pay retail prices. We usually get it somewhere in the middle. And that's fine. So the world is designed to work that way, right? The free market forces of supply, demand, and fair value kind of bring prices to where they should be so that most people can afford things. Not everybody, but the majority. When it comes to the trading markets, unfortunately, that's not the action we want to take. We want to be the store that demands to pay wholesale prices. Okay? That's what we want. Meaning, in every other part of life, if we're looking at the chart of gold here, we usually pay prices in here somewhere for food, appliances, clothes, cars, whatever. We pay prices in here, and we're usually okay with that. Right? In the trading markets, sometimes we also pay retail prices, don't we? Have you ever paid too much for something? But it doesn't, at the end of the day, it doesn't hurt that bad, right? It's like, oh, I paid too much for that, but it's not the end of the world. However, when it comes to trading, we do not want to be a buyer or seller in the middle. We do not want to be a buyer up here near supplier or retail prices. We need to make sure that we're buying at or near wholesale prices. Does that make sense? And this is where people run into trouble, right? We're conditioned from such a young age, and just life experiences have us buying and selling things in life. So that's what we do. When we come to the financial markets, we take that same mindset, and why wouldn't we? Right? It's not like our brains are dual processor computers where we have a trading market mindset and a everything else market mindset when it comes to buying and selling, right? We need to, but most people don't. So that's where it's different. And buying down here does not feel good to people. Now, I don't want to get too far on that topic. What we need to focus on is step number one. When we come to a chart, the first thing that we do is we identify fair value for two reasons. One, we want to stay out of fair value. We don't want to buy or sell in fair value. And two, that leads us to our higher probability supply demand zones. Okay? It's all about structure and location. So when we identify fair value, now fair value has two characteristics. This all needs to be objective. Okay? The two characteristics that define fair value, one, where is that recent and relevant majority of trading activity? Clearly, this is where it is right here, inside here. And where is that wide and whippy trading? Same thing, recent and relevant. Start with current price. It's right here. Right? Notice how wide and whippy the trading is in here. Okay. Shuben, yeah, so we apply this supply demand fair values structure location analysis, right? The structure location analysis, we apply it to day trading, swing trading, longer term investing the same way. The difference is the workspaces we use. And yes, as a day trader, you may have fair value at I don't know, at a certain price, right? And your demand zone may be below that. And when you buy your demand zone, for that context, it's fine, right? For that set of orders that you're looking at with regard to supply, demand, the levels, it's fine. But that whole thing might be inside fair value on a much larger time frame, and that's okay. All right. But someone tell me why is price able to go up and down so quickly and easily inside this area here? What's allowing that to happen? In other words, what's missing here that allows that to happen, that allows price to go up and down so easily? Yes, exactly, Shuban. A lack of a large imbalance. Okay, the reason so think about it. everything we do, all the evidence we gather, all this supply, demand, fair value evidence we gather is meant to answer two questions. Where is price likely to turn? Where is price likely to move to? Okay? So back to that question number one. What causes prices to turn in a market? Well, a significant supply-demand imbalance causes prices to turn, right? Okay. The greater the supply-demand imbalance, the more likely price is to change direction. So the lack of a significant supply-demand imbalance helps, facilitates price movement. If we had a significant supply-demand imbalance inside this range right here, would price be going up and down so easily? No. It would stay here for a short period of time and shoot away in one direction and not come back. Make sense? Okay. So let's keep going. Now, our structure location analysis says once we identify fair value, look above that for our qualified supply zones and below that for our qualified demand zones. But that was step number one. All right, let's move on. Why don't we go to, I'm just going to kind of follow your lead in the chat. So we can go to the NASDAQ next. And just kind of one of the weaker equity index markets. At the moment, that can certainly change. As soon as this chart comes up here, there we go. So let's look at this chart right here. This is a So here's the NASDAQ, live chart of the NASDAQ. I think I've said this before, and if you're in our sessions, you know that we color code our supply demand zones based on probability. Why is this demand zone here a gray box, a gray square? Why is it gray? Same with this one. Why would that be? Why is that gray? Does anybody know? If not, I can just go over it. It's inside the range. Right? Yes, exactly. Inside the range. The 11,143 down here, this was our demand zone from last week. That was an outside the range demand zone. Okay, so we hit that, price shoots up, gets close to this supply zone. Now we come back, and this is where the majority of trading activity has taken place recently. Demand, supply, fair value down in here, and we have a demand zone inside that. So this is a lower probability demand zone. Okay? We would never take an inside the range demand zone just by itself like that. What we would look for, because again, the fact that this is in the middle suggests there's not a large supply demand imbalance there, okay? In other words, it needs help. It needs more, you either need more demand in here or more of a larger supply demand imbalance on the demand side. You need that in here. Or what else could help this? How about some inverse supply? That could help this too, right? So we map all that out with our structure and location analysis. So let's go over here. And let's see. Let's actually go to, we'll go to this market first. This is a bond market. Or maybe it's this one. Let's get to this one. Not that. I was thinking we might be closer to this, but we're not. Let's go to the dollar, another inverse market to stocks, and let's see how far we are from our supply. Okay. So we're going to look at this chart right here. Oh, look at that. So we're getting close to a tested supply zone in the dollar, the 105 area, right? Shuban, we really don't use the VIX much anymore just because it really doesn't help us. Sometimes it'll kind of just sit there when the market's moving. It certainly doesn't move at the same pace even as the S&P, which is sort of its opposite, right? And then, you can come back to the same VIX zone multiple times. So we just found that other markets are more accurate for us. So as major stock markets approach or reach, demand zones, we would watch for this dollar supply zone to be an inverse market to that and help stock markets turn higher. Notice the first pullback here. Price just touches the zone and falls. We call that secondary evidence. In other words, the first piece of evidence that suggests supply exceeds demand in here in a big way is the zone itself, and really the 3 or 4 things we look for in a zone. Then price comes back here, barely touches the zone and falls. That suggests that, there is a big supply-demand imbalance here. Does that guarantee there will be over here as price comes back? No, but it suggests that it's likely, right? As we know, there are no guarantees in trading. All right, so we'll watch for that. Now, as I go back to the, let's go to the S&P for a moment, which is slipping a little bit lower. And let's see how far. So this is the turn yesterday from our inside the range supply zone there. And we're still a little bit of ways away from the demand just below. So you can see that demand zone there will likely line up with that dollar supply. Okay? Now why focus on that so much? Because let's go back to the NASDAQ, which is where this whole thing started. Because this is in the middle of the range, it's it's inside fair value here. We would never take this zone in and of itself, right? Location of this zone, not structure, but structure a little bit, but more location of this zone suggests there's not likely to be a large imbalance. Does that make sense? Okay. If so, then let's keep going. What's the next market we want to look at? The Russell? You want to go look at the Russell? No problem. Zach, the futures or the ETF? Doesn't matter to me. Doesn't matter. My guess is you're going to say the futures, but you just let me know. So same thing with RTY. You can see here, we almost made it back yesterday to our inside the range overnight supply zone. That's what the gray circle is for, because it's an overnight zone. And we've come down to a lower probability inside the range demand zone. So you can see this is where the majority of trading activity is. Yeah, we're getting a little bit of a bounce here, but not much. Notice the difference, right? Here's the outside the range demand zone down here. Price couldn't even get there. Why? There's supply-demand imbalance is too big down here. There's way too much demand and not enough supply down here, right? Here, because it's inside of all this, very different story. Low probability, higher probability. Structure-wise, when you look at this demand zone, it looks great, right? Everything's there, strong move away from level, all that stuff. but location is more important than structure. Now, if we go back, just go back over here, you can see these demand zones in and of themselves don't look any better than that, but the big difference is location. We need to get outside these ranges, outside of fair value, right? Okay. Let's keep going. Yeah, we can pull up the Dow real quick. It's going to be very similar to the Russell, but we can certainly go there. So we recently had a turn lower. You'll see here from this is yesterday, I believe. We got up to our 30-minute supply zone and fell. Now look at how quickly price comes back to fair value. Remember, fair value is where the majority agree to buy and sell. Remember, competition to sell at supply causes price to turn and pushes it lower. Fair value, because it's where the majority agree to buy and sell, pulls price right back to it. So now from there, this morning we are hitting this, again, the same zone as we looked at in the S&P and the NASDAQ, right? Here's an inside the range, right? Clearly inside the range, right in the middle. Bad location. Overnight demand zone in the futures. When I say overnight, that means that the trading activity here was happened during the overnight session in the U.S., the Globex session. Make sense? So, boy, and the fact that we went so deep into this zone last week suggests that we can certainly go deeper into this one, but we'll see. Remember, we do have some inverse help in the area. Bonds, the dollar. Anyway, that's the, and then plenty of room to the 32,133 supply above. Yeah, we can look at the Euro Swiss, no problem. And you want to look at the daily chart, not a problem. So let's scrunch this up. Oop, need a little bit more data here. So we need to look back. So let's get that. Okay. Now let's scroll back. Hang on a second. This is something is going on here. Let's figure this out. Let's put a horizontal line down here to make this easier. Now we're going to scroll back until we hit price. So this is the last time price was there. So let's just go below that. I remember that. I'm sure a lot of people remember that. Boy, we really need to get, yeah, I mean, that's here. Hold on a second. Let's go over here. Yeah, I wouldn't say that that's demand. Okay. All of the ranges are important. Current fair value is obviously the most important, but prior fair value is key too. Okay. Zach, we did look at the Russell. Yeah, we spent time on the Russell. But with this one, the Euro Swiss, we would not say that that's a demand zone. Price can certainly turn higher here, right? We're far from supply, and we're in the area where it turned higher last time. But based on our rules, that would not qualify as a demand zone. Yes, the Nikkei. Let's look at the Nikkei, which is very strong. The Nikkei has been one of the strongest markets of late. And the Nikkei has been really helping guide our direction and where we look and what we're looking for with this larger time frame. Just going to bring this up for a moment. This monthly chart of the Nikkei kind of says it all. We've been, using this for a while to help with the S&P, the NASDAQ, the Russell, the Dow. But anyway, got that supply above and plenty of demand just below. I know I've said this many times this year in FX Street, but just for those that haven't been in the sessions, our outlook from basically the beginning of the year, because of the supply and demand zones on the chart, has been suggesting that we're not likely to go back up and make new highs anytime soon. The market's not likely to have this big crash, but what's likely to happen is we're likely to just have these range that slowly move lower, right? And they may have moved a little bit lower faster than we thought, but that's what the charts have been suggesting. That's still what the charts are suggesting. Jay, we have our very rule-based ways that we define the range, and then certainly how we define our supply-demand zones. That's not the purpose of what we're going over today, but we can maybe get to some of that next time. You can always go to those workshops too; they're free. We'll cover some of it there. Not volume profile. The problem with volume profile is we yeah, all that's in that with that Edge membership, you get the foundation supply demand course, and that's in there, right? And again, like I said, I mean, it's $49 a month. So we wanted to make sure that anybody that wanted to do it was able to do it. And anyway, all right. So let's look at the Nikkei. So we looked at that larger time frame. Let's go to the demand side, which we're going to find down here on the 60-minute chart. There we go. Inside the range demand zone. Again, you're looking at the strongest market here. So remember, the NASDAQ went pretty deep into its demand zone, right? And the NASDAQ's been the weaker market of very late. And then so couldn't even get back here. So this looks like there's a pretty big imbalance here. On the supply side, we're looking at the 180-minute chart. And there you go. So this is that first outside the range demand zone we hit last week. And then here's the next supply zone above 27,364. Okay. Make sense? But whether a market is, stronger or weaker than the others, we always want to do our supply demand fair value analysis, right? Structure location to all markets independently. And then we match them up. If it's an inverse market or correlated market. All right. Next market. Let me get out of that. GLD, yeah, we went over gold already, the futures. GLD is not going to be that much different, but we can certainly take a look at it. So we do have a 15-minute supply zone. Yeah, almost touched it today, didn't. So that is suggesting that there's quite a bit of supply up there because we can't even get to that level, right? Yeah. And notice where all of this trading activity is below it, right? The majority of trading activity here is really between about 170.50 and about 169.60, right? So currently we have fair value right in here, right? Above that, there's the supply zone there. The demand zone, I don't know that we're that close to it, but let's go take a look. Oh, there you go. Already touched this demand zone down here. Now, if you're wondering, how do we have a demand zone with no candles in it? That's not, there are plenty of candles there. So if you look at the, there's probably some, a pre or post market activity here that's causing that. That happens often. Okay. And then we can go to, yes, let's go to the euro. There it is. right? There's the euro hitting a demand zone for a second time. So let's go, let me go take a look in a second. So there is that. And on the supply side, let's see where that supply zone is. I know we had one. I forget what chart it's on though. Most of these I have memorized, but this one I don't. Ah, there it is. So this one is clearly above the range, right? And this one's easy. I mean, you don't really need strict rules to see this one, but yeah, our rules would have us looking at that right there. Okay. You know, you could take this, and this has been fine already. In fact, we have that on a different time frame, but we wouldn't use that again, right? You don't want to use a inside the range supply or demand zone for a second time. I just put that link for the Edge membership if anybody wants to join those sessions in the chat. Someone was asking for it, so I put it in there. Okay. One of the things we want to definitely pay attention to. So here's a zone that we look at, like, no, it's over here. We look at it, I don't know, once every few months, just as a reminder. But don't forget about the 99.30 demand down here, okay? And that one will line up with this right here. The 106, yeah, we can't, oh, it's not there, it's on the weekly. And we've gone over the 106 for a long time here. You just get some more. Normally, we probably wouldn't look at such a large time frame, but we're actually getting close to this one. Maybe it's on the larger time frame here. Let me see. No, it's definitely on the weekly. It's this right here. So it's really the 106, like 106.50. And the gap is just a touch higher than that. Okay. So let's keep going. And again, we can look at, why don't we look at we haven't looked at a stock. How about Apple? Let's look at Apple. Why look at Apple? Well, it's about 6% of the S&P and a pretty big chunk of the NASDAQ as well. We were looking at this one this morning in our session because after falling from our outside the range supply zone there, we hit this inside the range demand zone just a little bit ago. Okay. And if Apple's moving higher like this, so is the S&P, right? Again, it's inside the range, nothing to get too excited about. But and then the below the range demand zone, let me show you that. I believe that's on the daily here. Yes. Well, we don't have it on this workspace, but actually I do over here. So, oh no, there it is. Okay. Right. So this was the recent turn. We just had another. So you see how this very, very important. So this is basically it's a 420-minute chart. It's basically a daily chart. Okay. And whether it's Apple or an Forex market or crypto or futures, it doesn't matter. My point is, last week we came down to our first outside the range demand zone in Apple in a while. That means it was below this pivot low, this demand zone. I was really wanting it to come down to the 127.50, which is this one, but it didn't get there. That's okay. So it turned here, goes right back into the range, right? Back up into fair value, turns here, and now this morning, we're getting a little bit of a turn here. which is fine. But the outside the range supply demand zones are typically much higher probability than inside the range supply or demand zones. Okay? And a lot of people lose money because they trade inside the range. And I'm not even talking about, whether you use supply demand or some indicator, oscillator, any strategy. Trading inside the range, you need to be really careful and make sure that you stay away from the middle. Okay. See if the S&P can get through this little, it's been fighting this little 5-minute supply zone all morning. Again, we looked at this at the beginning of the session, right? The S&P was down in our little demand zone here inside the range, and it's battling this 5-minute supply zone up here that's holding up like a champ, which, oh no, not that zone. That's an old zone. Oh, I'm on the wrong workspace here. Hold on, let me go over here. I think that's in the NASDAQ. Just check. Oh, I'm sorry, 5-minute demand zone here. Okay, so we had this from these are little day trading zones for this week in the S&P. Okay, notice the location of these zones in relation to this. This is the focus. So if you're day trading the S&P, there's the fair value. We either want to look to be buyers at demand below that or sellers at supply above that. Does that make sense? Amazon, sure, we can look at Amazon. Amazon is getting close to a much larger time frame zone. It like Apple, it did come down to our inside the range demand zone here, right? But at least it's near the bottom of the range. And but here's the bigger outside the range. Look at that. Weekly chart of Amazon outside the range demand. We couldn't even get there the last couple months. We couldn't even get there. All of that negative news, all of the big drops in the market, Amazon can't get to the $99 outside the range demand zone. Why? Because there's such a big supply demand imbalance there. Okay, but didn't have a problem coming back to the inside the range demand zone, right? I guess it missed that too by a little bit, but you get the point. All right. On that note, again, I'll put a link in the chat. You can click on it because I know we're out of time. You can click on that, take a look if you like. It's this has been a very, very popular membership because it's basically anybody that is trading, that wants to join should be able to afford to join this. So it's been a pretty popular program, and hope that was helpful. And good to see everyone again. Make sure to kind of recap what we focused on today: the location of your entry points, whatever strategy you're using. Be careful buying and selling in the middle. Think of any big store that you buy items at, food, whatever. Okay, if the store bought and sold in the middle, would they be in business? No. They have to buy at wholesale prices, and they have to sell somewhere near retail prices, or it doesn't work. Okay? As a trader, investor, we need to think like that. Everybody wants confirmation when they enter the market. Unfortunately, that confirmation comes in the middle. You can have confirmation, or you can have the low risk, high reward entry in a market, but you can't have both. On that note, we will see you next time.